I'm moving on now to point 3 in my presentation, which rather tongue-in-cheek, I say, I call How Are Your Predictive Powers? Quite frankly, you should forget about prediction when it comes to making investments. If you look at the slide on the screen now, you should ask yourself whether realistically you would have successfully avoided these disasters in recent history. Any historian of markets knows that asset price bubbles have expanded and burst for as long as markets have been around. And as an investor, one has to ask oneself how many of them could one have realistically avoided. Political disaster and revolutions have ruined many people. Imperial Russia, Germany, Argentina, they were all considered blue chip investment sectors at the beginning of the 20th century, but woe betide those who invested too narrowly in one or indeed all of those economies. If you look at the screen, on the top left corner there, you can see a picture of banknotes being swept up in the Weimar Republic in Germany in the 20s. Money became worthless, the currency became worthless, government bonds became worthless. Next picture down, Russian Revolution. The Soviets reneged on imperial debt. Your Russian bonds became wallpaper. More recent examples, Lehman Brothers went spectacularly broke. A lot of people lost a lot of money. I was taken very much by surprise by the severe decline in commodities over the past few years. And you can see there a chart of the crude oil price, which has gone down and down. Chinese stocks, another example. This year and last, we've seen a meltdown in the China markets. Well, of course, for years, the BRIC markets were touted as the only growth area, the place to be, and lo and behold, it's become a vast bubble. And in 2016, we've had several days where China markets have been down 7%. Again, something very personal to me. I was working in Japan in the mid-80s, right at the height of this fantastic boom in securities prices. Looking back, I would never have guessed that the Japanese market was going to go nowhere for years and years and years. There you go. Many of my chums thought likewise. They built their reputation on soaring markets in Japan, and it was a very worrying and depressing time for many of them. But again, go to the bottom right-hand corner and look at what the MSCI equity indices did in 2015. Now, paradoxically, there you can see that the only equity market to perform last year was Japan. After all these years, well, would you have guessed that? And if you had guessed it, would you have wanted to have put all your eggs in one basket and relied solely on the Japanese market? Probably not. You could easily have been wrong. You probably would have been. So, really, the investor has got to get realistic and realize that he simply cannot predict with any degree of accuracy. And there is a blow-up of the Japanese market. But moving on now, equally important for an investor is the topic of survivorship bias. Now, so many investors are fooled by survivorship bias into believing in the magic powers of various investment gurus and fund managers. The reality here is that the great majority of apparently successful discretionary fund managers, hedge fund managers, or stock pickers, they're simply lucky. The great majority don't possess any great skills, or don't possess any skills which exceed those of Mr. Average, myself included. I don't possess any magic skills. So, the great majority of successful discretionary fund managers, they're numbered amongst the few survivors by chance out of a long list of those who have underperformed over the decades. It makes it very, very difficult indeed to choose an investment. So, moving on, my next topic here is the fact that active fund managers, stock pickers, people who take a discretionary view on investments, they underperform. It's as simple as that. You can see I quote there an article which was in the Financial Times on the 25th of October of last year, 2015. The conclusion is alarming, very alarming, but it is accurate. It's been borne out by countless pieces of research over the past 50 years. Many, many people have done the research and reached the same conclusion. So to quote, the evidence is stacked against a long-term investor looking for a fund that will both survive for 10 years and deliver outperformance. So the reality with active fund management is all you're really going to do is to try to pick the lucky survivors, the ones who succeed. There are alternatives, and we'll come on to those next, but don't be fooled. The majority of active fund managers out there actually do worse than the benchmarks. And obviously that famous thought comes to mind of thousands of monkeys throwing darts at blackboards and performing better than the professionals. Well, it's not a joke. It does happen. Mutual fund persistence in performance simply doesn't exist over time. And